Hello, welcome everybody. Thanks for being with us today. We're broadcasting live from Park City, Utah, where I am, and Boston, Massachusetts, where our guests from Helge Capital are joining us today. I have to thank my friend Prescott, who has kindly introduced me to the folks here, and want to make sure there's a shout out for him if he sees this recording. As you know, we can't hear or see you, but we encourage you to post your questions to the Q&A and the chat box as you review the presentation today. Also, we're going to be recording it and posting it to the Family Office Insights YouTube channel if you care to share it with others. And then we will be announcing it again later in the program. But we're going to be also doing another webinar on the 22nd of December next week. So as you listen to the presentation today, if there's others in your network or community that would benefit from hearing what you hear today, you're welcome to have them join in next week, or as I mentioned, hear the recording. Also, we're going to make sure that you're put in touch directly with our guests today. And so following the webinar, we'll make sure that everybody gets in touch with each other. So with that, don't forget to post your questions as they come to mind. And welcome and thank you for spending your time with us this afternoon. Oleg, am I handing it to you?
Well, I'll actually kick it off, Arthur.
Okay.
Appreciate
okay,
that.
Chris.
And,
yep.
Excited to be presenting to the Bevelis group and the Family Office Insights community today. My name is Chris, and I'm joined today by Oleg Uritsky, our CEO and founder, John Gosnell, heading up our operations and capital markets team, Darren Nolette, leading our finance team, as well as Nikolai Yinger to my left here, jack of all trades, focused on operations as well as capital markets. So by way of agenda, first we'll provide an intro to Helge Capital. Oleg will provide an overview on our history, who we are, what we do. Second, we'll offer a brief outline of the Boston Metro multifamily market, why we like it. Then we'll jump into Revere specifically and talk about why we're so excited about that particular area of the Boston Metro. And then finally, we will go through our current development and value add multifamily investment opportunities for which we are raising equity today. And just, we just love to mention that we're looking forward to getting to know many of the offices on the call today. And would be delighted to schedule personal follow-up calls with you if our strategy sounds like a good match with your investment priorities. So I'll turn it over to Oleg to talk about Helge.
Thank you, Chris. Good afternoon, everybody. Helge Capital, it starts with me, I would say. Approximately since 1994, 1995, I owned and operated a number of different businesses. Owned a transportation company, taxi medallions, I'm sure you're all familiar with. I sold everything in 2014 when Uber came to town, or even in 2012. Also owned and operated healthcare companies. We owned a chain of elderly daycare services. We were largest in New England. We sold the company to a publicly traded company, another company. Actually, they purchased us and they went public. And real estate, they've been always in real estate. In 2014, when all other operating companies got sold, myself and my partner Igor Schreier, we shifted all our capital and our focus into real estate, and that's what we've been doing ever since. We are highly focused. We only in Greater Boston area and in the multifamily. We do either value add or development, ground up construction. Please, back to you.
Yeah, and I'd say also just to mention on our track record since that time, Helge has acquired over 400 million of real estate across 22 acquisitions and completed 10 exits, generating a very healthy, very strong 26% IRR, and that represents over $122 million of dispositions. And so another note here just to mention is that we really own and develop what can be called workforce housing. We do not buy trophy assets or build ultra high-end luxury product. And another point worth mentioning is that we invest substantial personal capital into every deal that we do alongside our capital partners. So in the two deals we'll be discussing today, Helge principals and employees represent over 30% of the total equity. So we really view that as a key differentiator in addition to our highly focused investment approach. In terms of who you would be investing alongside, Helge's capital partners today consist of family offices and high net worth individuals, many of whom have done multiple deals with us over the years. And today, the current deals that we'll be presenting, we have committed investments from over 20 of such entities. And again, many of these entities are involved in both our value add as well as development deals. So when we fast forward to the future, we'll continue to build our expertise and actively pursue our dual strategies of opportunistic development and value add multifamily projects throughout the Boston Metro's emerging neighborhoods. We will remain a high conviction, disciplined, quality over quantity sponsor that does 3 to 4 new deals per year. I would rather do deals that we truly believe in and are happy to commit our own capital to, rather than more deals where we have a lower level of conviction. And we've found truly that the more active you are, the more opportunities you see, the more credibility you earn among local real estate market participants. And in some ways, 2022 was really a pivotal year for us, in which Helge broke ground and acquired over $90 million of multifamily projects in the Boston market. So we're very excited for the growth that we've seen in 2022 and to build upon that in the next year. But with that expanded opportunity set comes a real need for capital. And so that's what really brings us here today, is actively building relationships with new like-minded family offices, high net worth individuals, really with the hopes that it isn't 1 or 2 deals that we do together, but really that these relationships develop into programmatic investment partnerships that extend well into the future. So with that said, we'll jump into kind of the nuts and bolts of the presentation here. And we really like to start with why Boston multifamily, for those who are unfamiliar with Boston as a multifamily market. And we often have to remind ourselves that not everyone lives and breathes this market every day like we do, and kind of take a step back and explain why we're as excited as we are. So Boston, really, there's a structural undersupply of housing. Supply here is persistently below demand. And there are a couple of reasons why that's the case. On the supply side, there are really high barriers to entry to supply. Zoning restrictions, slow municipal permitting process, existing density of housing stock, scarcity of well-located undeveloped land, and expensive local construction costs all make adding new supply here on the housing side more difficult. And really, it stands in stark contrast to some of the other markets which have boomed in housing recently, particularly of note, Texas, Florida, Arizona, where we see that supply can be added much more freely and quickly to meet new demand. And at the same time in Boston, demand is very stable for housing, and it's underpinned by our world-leading recession-resistant industries, and particularly of note, we'd mentioned life sciences and biotech, and the core that's developed around Kendall Square in Cambridge, healthcare, as well as higher education. And we like to note that these are not mobile or cyclical industries. You're not going to see Harvard University relocate, or Mass General Hospital, or see the NIH start to pull funding to the biotech and life science core that we have here. These are long-lasting, stable industries with high-paying jobs. And a lot of the people that work in them, actually 50% of the retention rate we see a 50% retention rate of greater Boston area students after college, leading to a population increase of 10% in the last decade. So truly, it's an area where demand has consistently and persistently outpaced supply of new housing. And with the dramatic recent rise in interest rates, we've actually seen unaffordability of home ownership position multifamily to steadily raise rents, especially considering this robust local employment and wage outlook. So when you consider the average home price in Boston Metro of now over $800,000, it really puts into perspective the relative affordability of a two-bedroom apartment that's renting for $3,000 a month. So zooming in.
Hey, Chris.
Go ahead,
Yeah, you're probably going to get to it, but this might be a good time to just mention how is it incredibly competitive with other investors like you when there's something, because of the barriers that you just mentioned, when something that's interesting and desirable as an investor, do things get priced up, and is it difficult to win these? I mean, there's probably a lot to unpack on that question, but what's your experience in that regard?
Yeah, I mean, and other members of the team can certainly jump in on that.
Yeah, Arthur, we've got a great network, word of mouth around town. So with brokers and owners, we like to get a lot of our deals off market, which we do. Probably get 75% of our deals off market. So that's certainly helpful.
Yeah, that's exactly the point that I was going to hit on, Arthur, is that I think that our local on the ground presence here and our network and really the credibility that we've built in executing deals over the years has led to when brokers are thinking about who's a real buyer for a particular asset.
Yeah, you can actually close, right?
Us,
yeah.
Because they know we can close the deal, and that we're not we call it, we're not tourists in this marketplace. This is all we do. We're exclusively Boston. We're exclusively multifamily. And so that level of focus, I think, sets us apart and allows us to win some of those more competitive processes, because really understand the details behind what goes into an offer.
Totally.
Arthur,
Thank you.
Four of our last 5 deals were off market.
Yeah. Oh, well, look, I'm just an investor, so the ability to close goes a long way. If someone's willing to pay 5 or 10% more, but you'll never see the money, what good is it, right?
Yeah, that's a great point. And I think that on one of the deals we'll discuss today, our most recent value add project, our ability to close and actually close very quickly was a key differentiator that allowed us to win that deal. And our creativity in that process, really led by John and Oleg, led to that deal coming into our portfolio as opposed to someone else's. And we're really thrilled about it, as you'll hear.
What's the
Yeah.
impact? You know, I'm from New York City, so it's a whole different animal, and I'm not familiar with your area. But has the lack of desire to go back to the office impacted the demand for workforce housing or multifamily, or is it just, as you mentioned, pretty consistent, independent of the commercial real estate, business office?
Yeah, that's an interesting question. I think that at least on the value add project that we'll discuss, it's a project that has 72 very large, very spacious 2-bedroom, 2-bath units with storage, washer and dryer, outdoor space. So maybe there's an incrementally larger demand for more spacious, larger units. But I mean, if you think about the underlying drivers of employment in the Boston area, I mean, it's higher education, it's hospitals, it's biotech, it's life sciences. It's really not things that you can do from home very easily.
Yeah,
You
good
need to
point. Yeah.
lab to discover new medicine. You need to be in hospitals to treat patients. And we've seen that higher education and while it's had some experience online, there's a real desire to get back on campus. So I don't think we're maybe as impacted as some other markets that might be primarily tech focused, where you can maybe work from anywhere you have a laptop and an internet connection.
In fact, Arthur, to add to Chris's point, Bennington, which Chris will be covering, in a while, we added dens to a lot of our units to facilitate exactly what we're talking about.
You added what? I'm sorry.
Dens.
Oh, okay, yeah.
Home offices.
Yeah.
Home offices.
Yeah, dens. Got it. Yeah. Yeah. Is the Suffolk Downs thing still developed by the guy that did the casinos for the?
No, and actually, Arthur, we'll jump into that in a lot more detail later on because that's a key point underlying our thesis in Revere. And our development project is actually located right next to it, but Suffolk Downs is being led by HYM and Thomas O'Brien. And he's a real Boston focused, actually he's the former head of the Boston ZBA. And kind of a leader within local real estate permitting, but he's a mega Boston developer that's had a number of successful projects, and we think that's and just having heard from him and been to the ribbon cutting myself, Suffolk Downs is going to be really the most exciting of these. So we'll definitely jump into Suffolk Downs in a lot more detail, but you're right that it's a key part of the investment thesis for Revere.
And it kind of leads us to the next point: is why do we invest in Revere, Chris? If you will.
Yeah. So Revere, I mean, it really comes down to location, as it often does in real estate. But we see Revere as a key part of the Boston metro. It shares a border with Boston. It's one of the most vital, rapidly developing corridors in the region, as you noted, Arthur, with Suffolk Downs, with the institutional development that we've seen along Revere Beach. But it still presents a great value proposition. So as urban rents have continued to skyrocket in places like the Seaport, Back Bay, Fenway, young professionals who are working in these jobs in higher education biotech, life sciences, they're increasingly seeking relief in places like Revere. So we actually look at the 2020, 2030 projected population growth in Revere is close to 11%. It puts it among the fastest in Boston metro communities. And if you look at it in terms of real numbers, it reflects 3,000 additional Revere households by 2030. And so when we look at the supply pipeline that's coming on, it may appear impressive, and certainly there is a lot going on, but apartment supply still really vastly lags demand. And so we think there's a lot of runway for both additional development as well as room on closing that gap between a Boston and a Revere rent. So we kind of hit the highlights on Revere. It's a transit-oriented community. The MBTA Blue Line, it offers direct, reliable access to downtown Boston, and it runs right through Revere with multiple stops. And it's, I know if you've read the news specifically in Boston, some of the lines have been closed down recently for repairs and renovations. The Blue Line's very reliable historically. It's actually been invested in very heavily by the MBTA. So the Wonderland Blue Line station was recently renovated to the tune of, I think, close to $50 million. And then stations at Suffolk Downs and Beachmont, both adjacent to the Suffolk Downs development, they're going to be enhanced and be incorporated into real retail squares, retail plazas. So both of those stops that you see on the map next to Suffolk Downs. But in addition to just the public transit, Revere also, just by virtue of where it's located, it offers very convenient auto access to Boston, to the Cambridge job centers, as well as folks who work on the Route 128 job centers north of Boston, places like Burlington or Waltham. So there are you can get to a lot of places easily from Revere, and not the least of which is also, if you see on this map, a short drive to Logan International Airport. But despite this connectedness to the downtown core, a really kind of differentiator or exciting piece of Revere is the natural beauty and the recreational opportunities that abound. So if you saw on the aerial there, both of our projects are located a short walk to the very popular Revere Beach, 3.5 miles long, wide, sandy bathing beach. And Sora Revere is actually directly across the street. That's our development project, developed directly across the street from Belle Isle Marsh Reservation, which offers scenic hiking trails, and Point of Pines, our value add project, is both directly across the street from Gibson Park, offering tennis, basketball, baseball, a playground, as well as the Point of Pines Yacht Club. So I guess it's, with Revere, you get connectedness to downtown, but you also get truly unique natural beauty right outside your doorstep that we think separates it from a lot of other major cities, that you just don't see in a lot. You don't see that kind of ability to take a walk to the beach and also be downtown in 15 minutes in a major city, very many places. So it's a real differentiator. And we haven't been the only ones, obviously, that have recognized this. So as we alluded to, Revere's part of a dynamic, transforming neighborhood. Institutional development has entered Revere really dramatically in the last 10 years. Suffolk Downs, Arthur, as you mentioned, it's going to be the largest private development in Boston's history. So it's 161 acres, 16.2 million square feet, brand new, master planned neighborhood. Includes over 5.2 million square feet of office and lab space. So it's not just housing, it's not just labs, it's truly a live, work, play destination with street level retail and restaurants. And this is not something that's, while you're seeing a rendering here, it's not something that's far off in the future. It's under construction. It broke ground last summer, and we'll start to see the next jobs there in the next couple of years. So really, Suffolk Downs and its importance to Revere and Boston Metro in general can't be overstated.
Yeah, it's beautiful.
Yeah, it's really impressive. I was on site there for the ribbon cutting, the groundbreaking this past summer, and you know, it's a truly expansive space to be so located so close to downtown Boston.
And take note how close it is to our project Sora Revere.
Yeah.
Yeah.
It's a great point. And then on a more local level, we'd also highlight Gibson Point and the development that we see going on there, which is just directly next to our value add project. And the developer there, you know, and it's a similar story to Suffolk Downs, very experienced, very long time developer called Redgate. They did a number of successful projects on Revere Beach, which have since sold for record high price dollars per unit. And they've actually moved north right to where our value add project is located. And so this project just broke ground in the summer of 2022 as well. 291 units of multifamily, ground floor retail and restaurant. So in both cases, the deals we'll talk about today are very well positioned, or located just a stone's throw away from large, brand new institutional developments. And so, you know, you might be thinking that this is competitive, and we do get that question a lot. But really, we look at this adjacent institutional development as highly complementary, and really an important part of the trajectory of the neighborhoods that we want to be in, which are new neighborhoods, emerging neighborhoods. And now Nikolai will dive into some examples of analogous Boston Metro neighborhoods that we've seen in the past, and kind of give your listeners or your viewers an indication of what we kind of see Suffolk Downs and Revere Beach more broadly looking like in the future.
Sure. Thank you,
Great.
Chris.
So,
yeah, so-
Nikolai, before you jump in, just two quick things. When we talked before a little bit about Kotzeg, and so we have a question about that from the audience, so just cover that at some point. I just want to make sure he knows that we're going to cover it. And then
yeah,
Want to cover it now, Arthur?
no, hang on one second. And then the resilience that you've described with, you know, MIT, Cambridge, the hospitals, the biotech, would you suggest that State Street and Fidelity are not going anywhere either, and so they're likely to have the same?
No, it's a great point. In some ways, you know, Boston's economy, there's an embarrassment of riches here in terms of the number of underlying drivers.
Yeah.
But you know, we focus on the most recession resistant in biotech, life sciences, healthcare, and higher education. But you know, truly, Boston's also a longtime hub of financial services with Fidelity, State Street, and others. And we're also, you know, an emerging technology hub. And so, you know, so we've got a lot of things going on. You know, we focus on the most recession resistant because, you know, we understand there's turmoil, or there's, you know, potential turbulence on the horizon. But, you know, it's not just those three. You're right to mention that, Arthur. A lot of people here do very well in finance or tech as well.
Well, speaking of State Street, they're actually doubling down on Boston. HYM recently built a building at One Congress for them, and they definitely have a strong foothold in Boston.
Yeah, for sure. Yeah.
So as I move into a little bit of a representation of how Boston has grown and actually expanded in the last decade, you know, I really want to start off with Seaport as a prime example. It's located very close to Boston, and In this case, you're looking at a 2010 visual of the Seaport district. And in just 11 years, the Seaport has fully transformed into a beautiful community. It's a master plan development completed over the 11 years since 2010, 2011. Seaport is now home to an ecosystem of more than 350 companies from global leaders, including technology, biotech, and startups. So the number of jobs is also increasing, even more than the supply for housing. Here's an image of Assembly Row, a once barren field on the northern side of Boston, and it's also been under development, and they finished up. It's been fully transformed into a thriving neighborhood with shopping malls, restaurants, office buildings, and the Mass General Brigham headquarters are also located here. So this is just a 12-year transformation. Here's Alewife. It's a small neighborhood near Harvard University, and this is a commuter neighborhood just 25 minutes away from downtown. And it was once covered with parking lots, garages, and since then it's become a interest of investors, and it has been built up and turned into a really big commuter neighborhood. So here's one that's a little bit closer to us in Revere. This is it in 2013, and it's another example of an up-and-coming neighborhood, mostly covered in parking lots and various industrial buildings. And in 2022, it's been converted almost entirely into a thriving neighborhood. Probably around 4 years left until this strip of beach is fully constructed and at capacity. So here's another angle at Revere Beach. This one is ours, 90 Ocean. We built it we finished it in 2020. Well, 2021, June 2021. And you can see right here, this is us. The gray one is 90 Ocean, and the blue and green one was actually acquired by Investco. It's an institutional capital company. They've acquired it at a premium, and it really underlines the fact that we're an institutional capital adjacent investor, and we're looking at opportunities in these up-and-coming areas. And we can cover a little bit about 90O as a case study. We built it for just over 25 million, and just recently it was valued at $37.5 million. So this was a very successful investment, and it really outlines our approach to development. It's transit-oriented, it has favorable debt terms, it's located in an up-and-coming neighborhood, and it's an institutional adjacent investment.
You got 2.09%. Because the Fed just bounced up 50 more basis points today, so good for you guys.
That was expected.
Yeah.
And like Chris was mentioning, Suffolk Downs is the next up-and-coming neighborhood. It's going to be, in fact, one of the biggest ones. This is what it looks like right now. On the upper left-hand corner, you can see some ground was actually moved around. In fact, right now they're putting up a steel frame right there for their first building on Salt Street, and in 2026 through 2028, it's going to start taking shape. It's going to be over 20,000 housing units and over 6 million square feet in labs and life sciences commercial real estate. So this is really the up-and-coming neighborhood that we're focusing on, and it's going to create the most value for us. And I'm going to give it back to Chris to talk a little bit more about our current deals that we have on the market, but not on the market, we're raising capital for, and some of the deal highlights as well.
Great. As we go into this, can we just cover knowing that you're not giving tax advice, the cost seg depreciation benefit?
Yeah, I think it might be a great time to do that, Arthur.
Yeah, Arthur, we do a cost segregation study on every single project that we do. As you know, it gives excellent tax benefits. Typically what we see when we do the cost seg study, we see the depreciation dollars in the first year typically total about 2/3 of the equity pool, is what we typically see.
So the question from the audience is, for example, how much depreciation can we expect for $100,000 investment, just to use an easy number? And you just answered it.
66,000.
Yeah.
Yeah. Typically, it's about 2/3 of the equity pool. Yeah.
Yeah. Great. Excellent. Thank you for that. Carry on.
Yeah, so with that background, we'll jump into two deals that we're currently syndicating equity for. And I alluded to earlier, Sora Revere, which is our development deal located directly next to Suffolk Downs, as you saw on the previous map, as well as Point of Pine. So kicking off with Sora Revere, the business plan here was really an opportunistic assemblage of parcels, which we were able to locate, which we were able to assemble directly adjacent to Suffolk Downs, as we talked about, the largest private development in Boston history. And we did it at a time just prior to Suffolk Downs breaking ground, which is truly amazing timing because, I'm not going to say it's under the radar because it's been a long time coming, Suffolk Downs, but when you break ground and start to see construction, it really raises its visibility, and the number of articles and coverage that we've seen in the Boston Globe and Boston Business Journal just over the last several months has ballooned as renderings have been released and new construction activities going on there. So the plan here at Sora, it's a 5-year hold, complete construction and lease up. Really follow the same game plan as 90 Ocean Avenue, which Nikolai discussed, 75-unit ground up project, which Helge completed in 2021. That's just a little over a half mile away. So we've been in this market. We've done this type of development before. This is a little larger and has a great location. So we're thrilled to be working on this really extremely rare parcel where you can walk to both Transit as well as Revere Beach. It'll be 114 units when it's completed. Because it's located in Revere and not just 500 feet away in Boston, it'll be 100% market rate. So there's no affordability requirement on this new development. And we acquired it. It's been contributed to the development at a discounted permitted land cost basis of $60,000 a permitted unit, which we think is extremely attractive for investors, as we've seen other transactions recently closer to $70,000 a unit. And I really want to note here, construction now is well underway. So this is a closed deal. It's not something that might happen. It's something that's happening now. It broke ground this past summer. And it's, you can see here the development progress that's ongoing as we speak. Folks on site doing the hard work to get this building up. So it's really a great time to come into this project as we close out the equity raise. And just hitting the highlights on what attracted us here. Sora Revere, 93 Bennington Street. It's a 4-minute walk from the MBTA's Blue Line stop at Beachmont, which will be entirely redeveloped in connection with Suffolk Downs. It's a 15-minute ride into downtown Boston. It's the same easy auto access to Boston and Cambridge we talked about earlier. This location in Revere, it's just a short walk to Revere Beach. But you also benefit from 40 acres of public open space and trails, which will be present just next door at Suffolk Downs, as well as on your other side, hiking paths overlooking the Atlantic Ocean at Belle Isle Marsh. So truly, it's a place you can walk to the train, be at your job in 20 minutes in downtown Boston, and go for a hike or a swim after work. which we think is pretty compelling. And at the same time, the underwritten rents that we've got in this particular property are really substantially below comparable rentals in downtown Boston. Looking at the numbers, we're $1,000 a month less for a 2-bedroom compared to Boston. In terms of, what does that mean in real dollars and cents? That's approximately $3,300 a month here at Sora Revere versus $4,300 in downtown Boston. And again, it's worth noting that 100% of the units we build here are market rate units. And if this project were just located 500 feet south in Boston, it would have been subject to an affordability requirement of 13%. So really that market rate component truly allows us to capture future upside to rents. And that's a great segue to the fact that over the next 5, 10, 15 years, as Suffolk Downs comes online, as units are built, as lab space goes up, as retail squares are established and populated, and as Suffolk Downs becomes one of the neighborhoods that we see, as Nikolai highlighted, throughout Boston Metro, the upside here on rents is tremendous. So it's a closed
likely
deal.
to increase, yeah.
Yeah, it's a closed deal. It's under construction. Those photos are just from last week. So we're thrilled to be underway there, but do have some room, as we'll allude to later, in the equity raise. And the other deal, that we're fortunate to close in September of this year is Point of Pines. It's 190 North Shore Road. It's in the northern part of Revere. This asset, it's a very straightforward value add business plan. It's a process of marking below market leases to market and completing a property-wide renovation program to enhance cash flows. Again, because it's in Revere, it's 100% market rate, 72 units. We model a 5-year hold, which allows us to complete a renovation program with all 72 units and common areas. And just like the construction you saw underway at Sora Revere, our asset management team's on site as we speak, completing the 2nd through 4th unit renovations. So our first unit's been renovated. We have 3 more expected by the end of the year. We're looking at a 2-year schedule to renovate all 72 units, 3 units per month, 45 days of downtime. We look at that as very conservative based on our historical experience operating this type of value add project. So as I mentioned, first unit's been renovated, and the Matterport tour is live. So I'd love to, share that with any investors who are interested in seeing exactly what we're doing. But it's informed, the types of renovations that we make are informed by our experience at 9DO. And so, John could get into it in great detail, but it's really kitchen countertops, tile backsplashes, bathroom mirrors and vanities, shower tubs and tiling, new flooring, new paint colors, enhanced lighting throughout. So while you might say it seems cosmetic, we found these improvements really make a tremendous deal in the look and feel when you're bringing a new prospective tenant through the space. So with that said, in-place rents here are $2,300 a month today. They're really substantially below comparable properties, which we look at as closer to $2,600 or $2,650, which is indeed where we saw the most recent trade outs at this very property without any updates at all. You might say, we anticipate the question of, why is the rent so far below market? Can that truly be the case? And the fact is, this was really a geographic outlier for the family office, from whom we acquired it opportunistically. So they really operated this asset for 100% occupancy rather than pushing rents as high as it could be. Their assets are primarily located south of Boston. So there's not the same level of focus when you've got one asset, 45 minutes away by car than the rest of your assets, and it represents a small piece of your portfolio. Fortunately for us, we have 100 units just north of this asset in Lynn, downtown Lynn. We have 75 units just south in Revere Beach. So this is directly core to our operating portfolio, and we can be laser focused on improvements operationally, on the leasing side, on the marketing side, and really on executing our business plan there. So as I said, we underwrite post renovation rents here of around $2,900 a month. We fully expect to achieve that. We think it's conservative. It's still a substantial discount to Revere Class A. That as you saw previously is closer to $3,300 a month. So our goal is not to close the gap completely with Class A, but really to bring this to a level of Class A minus for a prospective renter that truly values spacious apartment living with outdoor space, without necessarily paying for all of the bells and whistles of a public exercise room or a public pool in the lobby.
Yeah,
But also
I noticed there was terraces, so that's a plus. And how does it work when someone's about to go off lease? Then you renovate that one because it's 100% occupied now.
Yeah, so John
We do
has
it,
this down
so we do it
in detail.
strategically, right? So, 72 units on average, you've got 6 months that are expiring. So we'll renovate 3, as Chris pointed out, and then we'll negotiate with the other 3 tenants, the 3 highest paying tenants of the 6, and we'll negotiate the rent to market levels pre-renovation to about $2,650. And we'll sign 3 of the tenants up, and we'll expire 3 of the leases.
Yeah, totally makes sense.
Okay.
Couple quick things before we run out of time. You show hold periods. Have you traditionally held to those hold periods and not recapitalized and hung on to the property so you could take the money off the table, or how do you guys view that?
Yeah, so I think our hold periods historically have been somewhat shorter than the 5-year holds that you'll see targeted for these assets. And part of that's a conscious pivot that we made to be a longer term holder of our assets for cash flow and appreciation. And so we really think, specifically in the deals we're doing today, there's just a lot of upside that we need at least a 5-year hold to achieve. And it may be that opportunistically there's a refinancing event that occurs inside of that and takes some of the equity off the table and results in a longer hold period. And we're always monitoring the capital markets for those types of opportunities. But we're not a company that wants to do a lot of deals very, very quickly that we don't necessarily believe in. We want to do fewer, higher conviction deals in areas where we see a really long runway of growth. So
yeah, I think Arthur, a great example of the refinance is the Gross One portfolio. We acquired 100% interest in that in March of 2017. We did a $11 million refinance March of 2019, and then we did a $19.7 million refinance May of this year. So
yeah, totally makes sense. So
that's based on the capital was 22 million. So we refinanced almost 31 million.
Great. There's equity, since these are underway, totally engaged. There's equity room in both of them.
Yeah, so that's a great point, Arthur, and I wanted to hit on that and make sure that the investors listening are aware of it. So in terms of Sora Revere, the development next to Suffolk Downs, We do have some room remaining, just 14% of total equity, or 2.4 million does remain available for investment today. So that's 2.4 million out of 17.1 million total equity in a total project of $60 million. So certainly have room on the development side, and also have some availability on the value add project Point of Pines. We've got just over 22% of total equity remaining today, or 2.6 million out of a total equity check of 11.7, and a total project size of just under 31 million. So we'd love to welcome investors to either the development or value add, or really both deals, because we've certainly seen that we'd be happy to set up individual calls to discuss further, but certainly many of our investors find that they'd like exposure to both a development deal as well as a value add deal. There are certain metrics that make each of them appealing in their own way. But would also we'd note that in terms of those equity figures that I mentioned, they both include that Helge is over 30% of the equity, which would be co-investing directly alongside any outside capital partners that would come into these deals. So we do have significant
skin in the game. Yeah.
The skin in the game is incredibly important. Believing in our own deals, believing in the markets in which we operate, and so and that's why we try and go into the level of detail that we do, is because this is these areas and these assets. This is our key focus. You won't see us go out and start investing in another geography, or suddenly say, we want to be investors in lab space or retail space. We really pride ourselves on our focus and our level of commitment to the deals that we do. So, would welcome new investors
Also,
alongside
just
us.
just to continue on Chris's point there, we only manage what we own. We do not manage outside properties. We're vertically integrated.
That's an important point. Yeah.
Yeah, but we're fully concentrated on what we own.
So what's the a couple of risk questions? What's the resilience of the projected rents on a prolonged recession? Have you done scenario planning on how much you guys could take before you're in trouble with any of these properties in terms of rents?
Yeah, on the Point of Pines, it's about 2550 would be the number.
Yeah, I think in this case, we look at the Point of Pines on the value add side is so far below market today, and this market being so undersupplied, and Boston being relatively resistant to recession for all the reasons mentioned on our key employment drivers. We think of ourselves and the assets that we like to invest in as very defensively positioned for a recession, in the sense that we're not building the ultra high end luxury housing that you see going up in a place like the Seaport or Back Bay. We truly are building for the workforce that's here and is in jobs that are not going away, even in an economic downturn. So we think we're very conservative on our rents, and we're also where we position our investments is in a conservative and defensive part of the housing market. So I think John gave the very specific answer, and that's true. But I think that looking at it even more broadly, I think that if someone's concerned about a recession, there are a lot of other places around the country that will be hit much harder, much more quickly than Boston would be.
I don't mind telling you that because John knew the number, that's impressive, because most people don't. Good for you.
And that's, just to be clear, Arthur, that's with cash distributions included.
Right.
It's just to be
Gotcha.
perfectly clear on that. That's not to be, I don't know what your definition of trouble is.
Yeah, look, there's, as an investor, I want to know what can go wrong, right? And how you're going to handle it. And that could be any number of things, but I
Yeah, but that's
appreciate
inclusive of the 7% distribution. cash
the
to cash.
distributions. Yeah.
That just to be clear. And, you know, we're protected in regards to our loan terms also, like we do 10-year term, there's a 10-year term on this deal.
Oh, yeah,
It's fixed for 5 years. So that's every deal we do is a minimum 10-year term.
yeah, I mean, that's fantastic point. And so, yeah, I mean, in terms of a need to access the capital markets in a very inopportune time, you know, if we were to see something, you know, I don't think we will, but something similar to the credit crisis of 2008, 2009, you know, we're very cognizant about long-term debt and not being pushed to refinance
Refinance at higher rates. Yeah.
at rates that are unattractive. So yeah, on the value add deal, as John said, a 10-year deal. We think, you know, you'd never be able to get it in the market. You can't get it in the market today. 5 years fixed at 4.4% interest only for the first 3 years. It really gives us a tremendous advantage and is a great selling point for that value add property.
And just, I saw Nikolai had
Yeah.
what did you pick, the SOAR deal?
That was a sort of deal.
Yeah, that's not a typo either. That term is 30
Oh.
years, which is unheard of for construction. 30-year term.
No,
Brilliant.
So, in deference to the group, we're right up against time, but I will tell you there's a bunch of questions that you're going to get. You can answer directly to the people who ask them
Yeah, I love that.
post
great.
webinar. But this has been super helpful. Nice work. For me, it's just, you know, I look at things as an investor because that's what I am, but the focus on a region or an area, you know, and people say location, region, you know, it really has sometimes it's a little disconcerting when you're writing a, you know, $5 million check to a big institutional investor and you have no idea where the money's going and whose expertise from some business school graduate that's done an analysis and has no experience. So how about that for pain that I felt? So super grateful to the group here. We're going to do this again on the 22nd. So be sure to tune in or invite your friends that would benefit from hearing this. And then we're going to put everybody direct contact with, by the way, what's Helge mean?
I think it's my name in Slavic or whatever from.
That's perfect.
So it's really not much to the name itself. You know,
That's okay. Yeah,
years ago, so the
Yeah.
name.
It's good to know. So thanks all you guys for doing this. Really appreciate it. Nicely done. We'll make sure you get in touch with everybody and then we'll see you again next week.
Thank you, Arthur.
Thank you.
Yeah, looking forward to more conversations and looking forward to seeing the questions come across.
Yeah,
Thank you.
nicely done. And thank you all for attending today. And as I always say, thank you for sharing with us the only thing you can't make more of, and that's your time. Till next time. Thank you, guys.